Hey there, everyone. Happy Valentine's Day and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. This is one of those weeks where we see a lot of movement. We see an increase in volatility. We see elevated uncertainty, a lot of question marks in terms of what might be next. A lot of investors, I'm sure, that have hopefully been riding these markets higher, now starting to question downside risk in their portfolio. I would argue this is one of those times. They're all good times to look at charts, but this is one of those times when it can be really helpful because, as our guest today, Mish Schneider, will point out, it can be really helpful for sort of differentiating between a short-term brief pullback and maybe a buyable pullback versus something a little more significant, sinister, something with more downside potential that could really disrupt your return. So using charts, using key levels to identify and differentiate between those two scenarios can make all the difference in terms of your returns through the course of the year. With that in mind, let's get to our market recap and see how things played out. Before we look at today's charts, we're going to answer a poll question. We asked you recently, which equity benchmark do you think performs best over the next month? Large caps, mid caps, small caps, and I've highlighted just the key ETFs that most people use to express those. There's obviously a lot of different ways to sort of get exposure to these different areas. Large cap getting the most responses, about 53%. 35% of you said small caps, the IWM, that's the Russell 2000 ETF, and only 12% saying mid caps. So two observations I would make on this one. Number one, I'd probably say large caps, only because the main reason is because we're talking about over the next month, and if the market does continue to be a little squirrely, which I think is most likely going to happen seasonally, February into March is a little weaker than normal, particularly in an election year. Defensive positions usually mean large caps, and either it's going to be large cap defensive stuff or it's going to be large cap growthy mega cap names that are probably going to survive any sort of market turmoil. So either of those scenarios seems like large caps are going to be better. I think small caps would be a close second for me, only because small caps are weighted in some of those sectors that probably are going to thrive if the growth trade starts to cool off a little bit, right? Where do things rotate? Could be to financials, industrials, and some of those sectors that are a little more weighted in small caps. So thanks for answering that poll. I would encourage you to use charts as a regular way of monitoring those different, what we call cap tiers, and think about large versus mid versus small and what those movements may mean for your portfolio. Keeping going here with our market recap, nice rally to end the day today here on Valentine's Day on Wednesday the 14th. The S&P closing just slightly back above that 5,000 level. So the S&P, we'll call it 5,001 almost, up about 1% from yesterday's close. So, again, big drawdown yesterday, nice recovery today, not getting all the way back up there, but a nice move higher when we think about the rally going into the close. The NASDAQ composite up 1.3%, mid caps, small caps all up as well. So the S&P 600 was down, 3-4% yesterday, so we're up 2% today. So that doesn't erase the loss that we had yesterday, but it's sort of a nice bounce after initial pullback. So what's so interesting about this is I would say whether you're bullish or you're bearish right now, and I would describe myself as generally bearish on the short term, but still bullish on the long term. Others, like today's guest, you'll hear a little more constructive about the market right here. And again, there's plenty of reasons to have some different takes on things. What you have to remember is that yesterday's gap lower and today's recovery, if you're bullish, you see that as a brief pullback and buyers coming in. This is sort of the all clear. As someone who's a little less bullish at the moment, I would say that gap lower, most likely in any scenario, is followed by a little bit of buying. So after yesterday's gap lower, if you ask a bunch of market strategists what happens the day after, we would all say we probably get a bounce back to the upside because it was such a big loss very quickly. You had the nice rally into the close, which means we probably get a bounce today. I would say the remainder of this week, Thursday and Friday, are going to be pretty important to see which of these was the aberration, right? The big gap lower after the CPI data, was that the fluke and then the uptrend continues, or is today the little bounce the fluke before we continue to retrace after yesterday's sell-off? That's why we'll keep looking at the charts here tomorrow and beyond. The VIX pulling back a little bit, and not a little bit, quite a bit actually, down about 1.5 VIX points, we'll call them. So we're just around 14.4. So the VIX is sort of down in the low teens. Yesterday spiked up into the mid-teens. Today kind of pulling back a little bit. This is one of those choppy periods where the VIX is actually going to move quite a bit. So there actually is a VIX of the VIX, $ VVIX, and you'll see that it's actually elevated as well because the VIX itself is actually moving very, very quickly after remaining very low in those sort of that 12 to 14 range for quite some time. Let's go to the bond markets yesterday, and you'll see the general theme with today's session is whatever happened yesterday, the opposite happened today, but on a less magnified scale is how I would describe it. So interest rates, for the most part, pushing higher yesterday. 10-year yield moving up above 4.3%. Today we're coming back down a bit. So the 10-year yield around we'll call it 427. Long bond yield end of the day around 445, and the 5-year point around 425. So again, elevated relative to where we've been here in recent months, but pulling back after yesterday's bounce higher. Bonds, of course, are pushing higher today after selling off quite a bit yesterday. So the TLT, the AG were both up. The TLT's up about 0.5%. The dollar index, not much of a change, and I would say that the dollar overall has been strengthening today, not really giving back any of those recent gains. Gold ended up being flat for the day. Silver prices slightly higher, about 1.2%. Oil, natural gas prices all came off, and the energy sector in a familiar position near the bottom of the list of the 11 S&P sectors. Cryptocurrencies very much back to risk on. So yesterday you had that sell-off, you had the rally as the equity trading session was completing. Overnight, we really pushed to the upside. Bitcoin back above 50K and more. So Bitcoin currently around 51,550. Ether prices around 2760. Both of those are up a decent amount from yesterday. And Bitcoin, again, sort of pushing back above that 50,000 level. I think that's a key, big round number, a key level to watch. And as long as we hold that, I think that opens the door to further upside. 60K would be the next sort of general objective that I'd be thinking about on the upside. And then we're not far off of all-time highs in sort of the upper 60s. Looking at our 11 S&P sectors, you can see industrials and communication services having the strongest days, up about 1.6 to 1.7%. After that, it was consumer discretionary technology essentially tied for third, just above 1% higher for the day. On the downside, some defensive sectors and energy as well at the bottom of the list. So consumer staples and energy, the only two out of the 11 sectors down on the day, and not by much, just slightly lower. So yesterday you had all 11 sectors down. Today we have all 11 sectors almost back to the upside. Just to finish off here, I do want to mention the Magnificent Seven charts, and Netflix having the biggest up day, up about 4.5%. We're going to talk, if we have time, about charts like Netflix, Meta, and Amazon. These are names that really are consolidating here recently. You have some of the names that are just doing quite well, like NVIDIA. You have charts that are doing quite not well, like Tesla. Then you have these charts that are in the middle, kind of choppy, names like Apple and Alphabet. But these three are really in a short-term consolidation. Netflix for today, not quite breaking up, but getting back to the upper end of the range. We'll look at that chart here in a few moments, time permitting. Looking at a daily chart of the S&P 500, once again, we teased that trend line that I've been talking about, but we didn't close below it. And again, in this sort of environment, how do you sort of minimize a drawdown, right? How do you make sure you get out of the way if the market really starts to tank? What I would tell you is you don't have to have a crystal ball. You don't have to predict the future. You just have to have good money management strategies. And I think technical analysis charts provide a really good general way of applying money management in a consistent way. I think trend lines are a great way of sort of representing the pace of a trend. So we have the trend line off the October low and the mid-January low, the late January low. You can see that's lining up really well with the price action this week. So yesterday we traded below this trend line, but closed literally right at it. Today we actually opened above. We traded right down to the trend line and closed higher. So this is price action telling me that buyers are coming in and buying that short-term weakness. And you want to get nervous when that doesn't happen, right? When we gap down and no buyers are coming in, that's when things get concerning. I think one of the ways we could tell that is if we break this trend line. It doesn't necessarily mean the end of the world, but it does mean that the uptrend that we've observed up until that point is now changing, where we have a change of character. So overall, the market still in a medium-term, long-term time frame, quite strong. The momentum overall is constructive. We're just looking to see if we break those initial trend lines, just telling you that something might be different, not getting that confirmation just yet. Let's bring up a chart of the VIX because the VIX did spike up quite a bit yesterday. We talked about the VIX getting almost to 16. Today kind of coming down a bit, down in the 14 handle kind of range. And again, I think a VIX above 15 gives you an initial warning signal. That's sort of the things are starting to happen and you want to be ready. A VIX above 20 is where things are really getting ugly, and a VIX above 29 would be, if you're not defensive by that point, you really want to rethink your overall long-term structure of the market. But that's a long way from where we're at, and I think today VIX going back below 15, sort of a nice reset. Look to see through the remainder of this week if we do get elevated volatility. Elevated volatility usually coincides with weaker risk assets, particularly the S&P and the NASDAQ. This is a chart that I simply call the chart, and I just want to highlight this because it combines what I would say are frankly mixed messages. I think there are pieces of evidence that are clearly still constructive. There are some that are neutral, and there are some that are clearly more negative. And I want to highlight how this one chart sort of shows you all of them. In terms of the evidence that is still resoundingly bullish, I would say just the overall trend in the S&P is number one, right? Higher highs and higher lows. We keep doing that, the trend is up. And that's not a judgment call, that's not an opinion. That's just a factual assessment of the pace of the trend using the highs and the lows. So we keep making higher lows, the trend is positive, and for now it is. We also have offense over defense that's still quite constructive. This is an equal weighted ratio of consumer discretionary versus consumer staples, so things you want versus things you need. You can see that this is trending higher over the last 3 months. And even just in the month of February, it's close to making a new 52-week high. So overall, offense over defense still the rule of the day. In terms of neutral evidence, I would say the advanced decline data on the New York Stock Exchange is decidedly neutral. We're making lower highs and higher lows. We're consolidating, and while the S&P has been making new highs in January and February, the advanced decline data is actually neutral. So overall, not particularly good. The McClellan oscillator, we don't have time to show it, but literally flipping back and above and below the zero line every day or two. So it's a choppy, sort of noisy, unclear sort of direction. Then we have the negative stuff, the bullish percent index on the S&P 500, the bullish percent index on the NASDAQ 100. Both were above 70% and now are below, which means pretty much everything was going up according to their point and figure charts, and now we can't say that that's the case because we're below 70%. Look at what's happened in January and February as the S&P has gone higher and the percent of stocks above their 50-day moving average has been going down, right? So that's been trending down over the last 6 weeks. So what that tells you is forever NVIDIA well above its 50-day moving average, for the S&P well above an ascending 50-day moving average, things are great. There are a bunch of other things that are literally breaking down and failing to hold their 50-day moving average. That's happening more and more. About 30% of the S&P plus in the last 6 weeks, that's been what's happened. So overall, I think things are starting to break down. It's just not the big stuff and it's not the major benchmarks, but underneath the hood, I'm seeing breadth conditions less optimistic with some of those as examples of that. We'll talk briefly here about interest rates. I want to show you a chart of the 10-year yield. Someone had mentioned in some feedback, showing the 10-year yield more often. I totally get it. My biggest challenge with a brief market recap show, if I would describe it this way, is just trying to get to all these charts that I think are meaningful. What's interesting on the chart of the TNX, by the way, applying a simple Fibonacci analysis, right? Take the high in October. That's when 10-year hit 5%. Take the low in December. That's when the 10-year yield came down to almost 3.75. It was around 3.8%. We've now come up to that 38.2% retracement, which is right at 4.25. That's literally where we ended the day today. So I think breaking above 4.25 for me opens the way to get up to the 61.8% level, which is just above 4.5%. Now, if yields go higher and get up to 4.5, and God forbid even go further and start to retest those October highs, rates remaining in this current range aren't too bad, but the 10-year yield getting up to 4.5, 4.6, 4.7%, that puts a lot of pressure on growth stocks, which are literally the leadership right now. So when you think about what's holding the market up, it's those growth-oriented names still looking quite strong. Higher rates probably make that less likely. It's not impossible, right? And I think John Kosar from Asbury Research, one of our frequent guests, compared the something like this as what happens when you're riding your bike into the wind or whether the wind's behind you, right? You can still make progress if you're riding into the wind, but that headwind makes it a lot tougher. And I think rates going higher are a true headwind to growth stocks, which are really the leadership, the foundation of this market. Finally, we'll talk about Bitcoin, then we'll talk about some individual names to wrap up our market recap. Bitcoin continues to show a lot of strength. I would argue, and I haven't looked a ton at the flows, but my feel looking at some data on fund flows into the new Bitcoin ETFs, starting to be more and more constructive. Things like IBIT and others attracting quite a bit of assets. GBTC now stabilizing, starting to move higher. Bitcoin has bounced from around 39,000 up to now 51,000 plus. And so we're well above that green shaded area. I think getting above 50,000 and holding it, that really unlocks the potential for a return to previous highs. What's so interesting now, I'm thinking of my conversation with Adrian Zadunchik earlier this year. It actually might have been in December when I talked to him last, but we talked about the Bitcoin halving. There are a lot of things that could be happening here in the next couple months, which tend to have bullish implications for Bitcoin. So this could be setting up for a bit of further upside. Extremely overbought, noteworthy to note with an RSI above 80. That actually usually ends up being a long-term pretty constructive sign. All right, to finish off here, let's look at some individual stocks in the news on the move that you need to be aware of. Akamai Technologies, obviously a technology name, gapping lower, and I think this is the risk for this market. When I think about where your mindset is at, given what we've started to see this week, is the worst case scenario, if you own an Akamai Technology for like months and months, is in one day you just erase 6 weeks of gains. That's how quickly these gaps can unwind previous gains. So the bad news for Akamai is we've gapped lower. The even worse news is we've gapped lower below the 50-day moving average. The saving grace for now is that we are basically right down to that January low, and I think we're at that potential floor. Look to see if that can happen. Again, this is one of the reasons why we called this show the final bar, because the whole point is to look at the final bar and then look to the left and see where we're at relative to where we've been. We're right at those previous lows. This potentially is the kind of place, if this is a long-term structural idea that investors like, this is the kind of place where they would tend to buy in, digesting today's loss, but then you're buying in at recent support and start to push higher. If this doesn't hold, though, I think this is a concerning chart for the rest of the week. Uber and Lyft both having a pretty decent day here. Uber up about 15% today. Here's the chart of Lyft. Not quite as positive of a structure, but gapping higher about 35%. So these are two stocks that have certainly gapped higher. Lyft, in this case, breaking above the December peak. So I'd want to know if that can hold. And if it doesn't, look for this gap here and make sure it holds the lower end of the gap, right around $15 a share. So that's kind of the downward risk to this chart, but the upside potential, certainly quite a bit. 18 is this next sort of level of resistance, but above there, I mean, you're looking back at the gap from May of 2022. That's up in the mid-20s, which means a lot of upside potential on some of these charts, already gapping higher here. I want to talk for a moment about some of the Magnificent Seven stocks, three in particular: Netflix, Meta, and Amazon. You know, what's interesting is at one point it felt like all 7 or 8 of those names looked very, very similar. Now you're starting to see them differentiate a bit. You have sort of those strong and still strong names like NVIDIA, probably the best example of that, just continuing to push higher like it doesn't even care anymore. You have charts that are very weak, like Apple and Tesla on a relative basis compared to the rest of the group. And then you have these ones in the middle. And I want to highlight Netflix, which looks like this, Meta, which looks like this, and Amazon, which looks like this. And I'm going to zoom in just a little bit. We'll make it like a 1-year chart so we can just highlight this little consolidation. What's happened, all 3 of these names have sort of gapped higher here and now have stalled out. So in terms of Amazon, it's 175 to, we'll call it 165. With Meta, it's sort of this 445 to 470 range. And then with Netflix, which was the first one we showed, sort of 540 to 580. So all of these charts gapped higher, and now they're sideways, right? So we traded up a little bit, and now we're sort of consolidating. So I think the bull case for the markets here involves Netflix pushing above to a new swing high. It involves Meta and Amazon resolving these consolidations to the upside. The bearish scenario, these stocks sort of trade down to the lower end and start to fill those gaps. That would be the what's the disaster scenario or maybe the not so bullish scenario? It would be these sorts of names that are right at that point where it looks like they might have been taking a pause and then reinitiating the uptrend. If they fail to reinitiate, I think that could be a potential issue. And then finally, Enphase Energy up about 6.5% today. The real story, though, is bouncing off of that low in November. Making a nice higher low here around 95, retesting the December low, gapping once again on earnings and now trading higher. So gaps that are followed by additional buyers, really encouraging. Now I think this is a key chart to watch, and I'll be watching this 140 level, because if we can get above 140, that takes us above the 200-day moving average for the first time in quite a long time, and also takes us above the December high. So I think Enphase above 140, pretty constructive chart. That's it for our market recap. I want to bring on today's guest, Mish Schneider. Before we get there, a couple quick announcements. First off, we welcome your questions. Want to thank you so much for sending in some great questions for our Final Bar mailbag. We're going to be doing an all mailbag episode at the end of this week, and we'd love to feature one of your questions on the air. Our email is thefinalbar@stockcharts.com. We're on the Twitters @FinalBarSCTV, and on YouTube, of course, just drop a comment below the video you're watching. We'd love to hear from you. We'll hope to answer one of your questions in that next mailbag episode. Also, I will be doing a special webcast for market misbehavior coming up next Tuesday. That's February 20th, called Momentum Matters, How the Pros Use RSI. You'll know just from some of the examples that I've shown you, RSI is an indicator I have on most of my charts. And the reason is because I found it to be an excellent measure of price momentum, a good short-term measure of overbought oversold conditions, but also a longer-term measurement of structural trends and overall sentiment for a particular stock. Join me at that webcast. You can sign up for this free event at marketmisbehavior.com/RSI. That'll be next Tuesday, the 20th at 1 p.m. Eastern. We would love to know what you think. We're actually running a survey right now of all of our Final Bar viewers. We are thinking about how to evolve Stock Charts TV and how to evolve this show. Please use this opportunity to let us know what you like, what you don't like, what could we do more of, what could we do less of, and everything in between. You can scan the QR code on your screen to answer our survey, and please take 5-10 minutes and let us know what you think. We'll love to hear your feedback and look forward to really good things for the Final Bar going forward. All right, I want to bring on today's guest, Mish Schneider. Mish is the Chief Strategist at MarketGauge, coming to us from beautiful Santa Fe, New Mexico. Mish, good to see you again. You were actually our first guest in 2024. I feel like a lot's happened since we spoke the last time.
It does feel like a century, doesn't it?
It's a long time ago. So we have a lot to think about, a lot to talk about. But I mean, just before we get into your charts, just at a high level, quite a bit of choppiness. We had, yesterday's session with a bit of a drawdown, today a nice recovery. At a high level, like, what are your takeaways from what you've seen so far? Is this time to get nervous, time to be optimistic, somewhere in between? How would you describe your mindset given what's happened?
Well, I feel very bullish. Even with yesterday's big contraction, I felt that there were some key indicators to watch, which I know we're going to talk about. But the fact that there were so many sectors that held up and just fell to support was promising. I don't think the hyper-focus on every word that the Fed utters is necessary. I think basically we can say that even if they keep the rates where they are for longer, that may not necessarily be the worst thing. We've seen it actually be absorbed by a lot of companies. The earnings season was better than expected. And this is apart from the fact that we have, 29% of the SPY has been in the mega cap stocks. I've seen growth in a lot of different areas. I think that's promising. So in case, and even in a little rise in inflation, which isn't unexpected, unless inflation really goes crazy from here, and at this point, barring from a weather or geopolitical situation, I don't see why it would, other than the normal growth of inflation matching an economic expansion. It's possible that this market will continue to go higher, and there's always going to be the wall of worry, and clearly we saw that yesterday. So that's what we're going to talk about, is the signs that we would look for if that changes. But for right now, I'm very comfortable.
Yeah, I always encourage people, don't overreact to one day's information, but certainly it's brought a lot of things into question. I appreciate you setting up some charts to just sort of lay out some of the signals you'll be looking for. We have your chart of small caps to start off. This is the IWM. What strikes you here?
Well, yesterday could have potentially been a disastrous day. So, we have our indicators up there. When we get through a 6-month calendar range, particularly in January, and fail it, that could be considered a key reversal and a top. And clearly, the jury's out on whether or not that has happened. But on the flip side, we broke the 10, but we held the 50-day moving average, which was the encouraging thing. And then with the follow through today, in essence, what we were able to do was fill the gap that it left on yesterday's open. That's also always a positive. So what has to happen from here is, at this point now, if we're truly going to see any kind of rotation into small caps, and even if it's not necessarily rotation the way people classically think it is, but more like small caps finally catch up a little bit to what's been happening in the Qs and the SPY, we have to get through these highs of 202, 203. And if we can't, then the next time we start to turn down and break that 50, I think that would be a warning sign.
Mm.
Yeah, so, and then if we look at the leadership, today it recaptured the SPY in terms of performance. That's another positive. I mean, let's face it, if the small caps do well, that's better for the market generally and certainly better for the economy. And then, so I like the fact that it's slightly outperforming in that middle graph, the SPY. And then if we look at the bottom graph, which is the real motion indicator, we're back over the 50. Maybe the momentum isn't all that great, but I imagine, as we just said, if we can get through these recent highs that we saw in December, I think then that would be excellent and all around. So this was good. It was positive. It helped, but we need to see a little bit more.
Interesting, and I really love that illustration. Yesterday, the gap lower, bouncing off the 50-day. We'll see if we're able to regain that swing high from the last couple of days. It's a great illustration of just the impact of yesterday's trading. Second chart is looking at the high yield bond market. You've often brought high yield, and I think have spoken well to why this is an important area to look. What's your takeaway here?
Well, yes. First of all, talking about why I'm so obsessed with high yield is it really goes back to 2020. Actually, we're talking almost exactly 4 years ago when the market started out in 2020 pretty robustly, just like we saw it. Well, actually, the first week in January, if you minus that, we had been robust, except that junk bonds went right to the 6-month calendar range high that year and started to fail. And actually, by the time we got towards the middle or end of February, it started to break down under the 50-day moving average, and then eventually the 6-month calendar range low, and then eventually the 200, and then whammo, that's when we heard the news about COVID. Now, I'm not saying I expect a COVID-like event, but what it taught me was that this can be an incredible lead indicator. And so that's why I've started looking at it more carefully in the last few weeks, because it got right back up, as you can see there, to the 6-month calendar range high, started to sell off, held the 50, didn't quite get back anywhere, just sort of consolidated, which is fine. It doesn't have to go crazy to the upside or even really sell off to the downside. If it consolidates, that's good enough. It means that things are status quo in terms of investors in high yield debt, companies that are considered basically junk but pay well. And then, of course, yesterday it had that disastrous gap lower, but look where it auspiciously held, which is the 6-month calendar range low. And now today it popped back. So if we put the two evidences together of the fact that the Russells, although they've done better, still really need to get through that 6-month calendar range high to prove themselves, this was sort of dragged up, couldn't get back through the 50. So we want to see a move over 77. We see a move over 77 and the small caps continue up. You've got to really get bullish. And if you haven't been invested in this market, you'll have another chance. On the flip side, if the IWM starts to roll back over under 195 and this starts to break down under that 6-month calendar range low, as you can see here, we have a confirmation of a caution phase. It's well underperforming the SPY. And the momentum, of course, is weakening, but it's not horrible yet. Then I would say, okay, brace yourself, bigger correction coming.
I've mentioned to so many people when I worked at Fidelity, we sat, the charting team sat on the same floor as the high yield debt team, which I absolutely loved because I found that those guys were really laser focused on risk. And high yield bonds would often sort of detect things, right? It would be priced in uncertainty before equities a lot of times would reflect that. So 100% agree on the value of looking at that space. Great take there. Now, how important retail obviously has actually done a little better than other groups here recently. How important is that upside participation in retail here?
Well, considering that consumers 70% of the GDP, I would say it's pretty important, particularly since we still have people calling for recession. And we have people terrified of the higher rates, as we just talked about, or higher for longer, as really putting a kibosh on any kind of growth. And you hear all kinds of reports about credit card debt going up. But at the same time, there is money around, and here you are at the consumer. However, just like we saw in IWM or the grandpa, if this is grandma, cleared the 6-month calendar range high, fell yesterday, but not nearly as badly as the IWM did. And now here we are back today at that 6-month calendar range high. So I think this would be another piece of the evidence. If this rolls back over and breaks down under 70, and we saw the other two scenarios we just spelled out also happen, more evidence to be careful. However, if the other two remain robust, or even if they don't necessarily play as well as this does, and Granny XRT continues to get through 73, then we know the consumer's still in the game. And even with the slight elevation of CPI, it didn't really seem to impact the consumer that much. So this is another key area to keep an eye on.
I like that, Mish. And I mean, rates being higher, inflation still being an issue, it doesn't feel like the chart of the XRT is feeling those negative implications as much as we might think. I want to get to your last chart because this is an important one. We were talking before we started the show about transports and how much transports have really been leading here. Today, gapping higher in a pretty big way. What about the leadership in transports? What does that tell you about the environment here?
Well, you know, so now we are really completing what Druckenmiller called the inside sectors of the economy, which would be, of course, the small caps, the retail, and the transportation. And if you think about it, it makes a lot of sense because the small caps are things that are made in America. The retail is how much money people are out there spending. And the transportation is how robustly people and goods are moving. And if you look at today's action, well, first of all, looking at yesterday's action, of course, it gapped down, but it didn't really do anything. In 166, if you take your cursor back a little bit to the end of January, look how many highs you had at around 166. No, go the other way. The other way. Yeah, there you go. That whole area of consolidation. Well, I'm sorry, 266.
266, right.
266. 266 was the number. That really was a breakout area once it got through. And then all it did yesterday was break down right back to that support at 266. So now today with this massive gap up, if you take a look at a longer term chart, 282 and change is the all-time high. So everybody's so focused, obviously, on the major movers of the market, you know, not the least of which, of course, is NVIDIA. But meanwhile, this thing is really picking up nicely. So what that tells me, again, is the economy is in better shape than people like to think. And that if goods and services and people are moving, that is a very healthy sign. And again, means that we've had absorption or somewhat normalization of interest rates where they are. And also people are feeling that the inflation, at least at these levels, is something that everyone can live with. So these, now you've got it. You've got the whole picture. And no matter what you hear from people, all the fear or maybe the overenthusiasm of people who still think 5,400, it doesn't matter. This really is telling me right now, I'm very comfortable. And of course, as we know, is when things go into momentum, you make a lot more money following the things that are in momentum than trying to find the weaker things that might play catch up. And here you go.
We only have about a minute left, Mish, but I'd just love to ask, I mean, we've had a lot of questions recently about some of the leadership names that have just been continuing to push higher, like in NVIDIA. If you're holding a name like this and are concerned about what the run that it's had, I mean, how would you think about a chart like this that's already had such a run? How do you think about how to manage potential downside or to minimize, you know, giving all of that back, which I think is what people are just afraid of, the next big move lower. How do you sort of manage that risk? And how do you think about a name like this that's extended?
Well, this is a classic move that you learn when you're a commodities trader on the floor, especially if you were there when I was, when you had these commodities going absolutely parabolic. Is that you keep a core position. You can have fun adding to the position, but those you want to trade much more shorter term. And the most important thing is that even to the core position, you can take profits at certain tranches and have a wide enough trailing stop to exit that gives you some room for some volatility. Like yesterday, for example, would be a case where you didn't want to get blipped out because you're nervous, but yet not so much room where you feel badly if you wind up giving up 20% of your profit. And that's really the key to successful trading, is really understanding how to catch parabolic moves, not get out too soon, but also take your profits along the way up and feel great about the fact that you've caught one of the rare historical parabolic moves that you'll see in a stock.
That's a great take. And thanks for talking about that idea, the core position, how to sort of trade around it. This was awesome, Mish, as always. Good to see you. Thanks for coming back on the show. Please give our best to Keith and Jeff and the team there at MarketGauge. We'll talk to you again soon, all right?
Happy Valentine's Day.
To you as well, Mish. That's Mish Schneider. She's the chief strategist at MarketGauge, coming to us from Santa Fe, New Mexico. I love that take about, and she offered up, let me lay out these 4 charts that I'm looking at to sort of gauge what's happening here. And I love that approach of thinking of what key levels, what I call a line in the sand, what signals would you need to see that would tell you things are really getting uncomfortable. And until then, the default then is things are holding in there okay. So I think great charts and great investment wisdom there by Mish Schneider at MarketGauge. Folks, we've got to wrap the show and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. So we're showing 2 technology names, Apple in the top half, MCHP in the bottom half. And these are 2 stocks that I think, same sector in the technology group, but representing a very similar technical structure. This is what I would probably loosely call a failed cup and handle pattern. And I think it's a great cautionary tale as to why we need to wait for a pattern to be confirmed. If you look at Apple or look at MCHP, both of these have the same similar kind of pattern, nice rally in the summer. We peaked in July, then we have this rounded sort of pattern with a high in July, a high in December, and look how similar these levels are, right? We're kind of retesting that same level, so it looks kind of like a double top pattern. Then we sell off from that potential double top pattern, and then we retest the highs, and here we have the cup and the handle. Now, when people see a pattern like this, I find they often are way too eager to take a position because they think, all right, this is going to be a cup and handle. I don't have to wait for the breakout. Why don't I just buy it now? And then when it breaks out, I will have a much better entry point. Here's why you don't do that, because both of these never actually broke out. And this is why you need to be patient for what I call the trigger. With Apple, we talked about that level around 198 to 200. With MCHP, it's more around $93, $94 a share, but that's basically the top end of that cup, right? Think of the rim of the cup and then the handle. So when neither of these break out, now we're rolling over. So all this tells you is you just never had that entry point. We never had that validation. So with patterns like the cup and handle, with the head and shoulders pattern, triangle patterns, anything like that, remember, you really have to wait for those patterns to be confirmed before you can make assumptions about what it means next for that particular chart. Chart number 2, the GBTC. In full disclosure, I do own the GBTC in one of the accounts that I manage, but overall, I would say the chart of Bitcoin continues to be constructive. We had that sell-off after the Bitcoin ETFs were announced. You've now seen a nice recovery here. The GBTC actually found support at the December low and also at the 50-day moving average. But the reason why I wanted to show this chart otherwise was to highlight what we call an accelerating trend line. Accelerating trend lines, basically you have that initial trend line. Here we have the December low, the June low, the September low. All of a sudden, the price starts to get further and further away from our trend line. So the S&P is sort of the opposite. It actually broke down through the first trend line, so we had to draw a secondary trend line to recognize the new trend that we could interpret. Here we actually have an issue where the price is getting really far away from our trend line. So we need to draw a trend line with a greater slope to match the acceleration in the trend or the increased slope. So now I'm using that September low and I'm using the January low. Here's my new trend line. So as the pace quickens, you increase the slope of your trend line. And all that does is basically if a pattern goes vertical, you're able to lock in as many of those gains possible. And with any of these, as long as we hold above trend line support, the chart is overall pretty positive. Finally, and I labeled this not a good chart as a reminder of what I was going to tell you about. Energy stocks overall not particularly good. And my response, if you talk about why energy is a great idea, I'm like, why would you own something like this when there are other charts that are just in better technical positions, right? In general, I want to own good charts, not bad charts. So what actually makes this a bad chart? Well, it starts with sort of Dow Theory 101. The trend is down, and we know that by the fact that we have a pattern of lower highs and lower lows. We're below 2 downward sloping moving averages. The relative strength is ugly. We continue to underperform. The momentum is quite weak. The RSI hasn't been above 50 since this October peak. So overall, this is a chart going lower. Now, while you can make an argument of it's testing support, it's really beaten down, maybe there's a bullish divergence, I get all that, but as a trend follower, I'd much rather be patient and wait for that market to finally turn higher. Wait for validation that all of those conditions I just mentioned are changing. And I think particularly thinking about that webcast we'll be doing on Tuesday is the RSI improvement, I think, is one of those sort of underneath the hood subtle changes that a lot of times will tell you about a shift in momentum before the price actually reflects it. Folks, that's our wrap for today's show. But before we actually run the closing credits, I do want to let you know we actually ran the numbers yesterday and discovered that last week we had our 1,000th episode of The Final Bar, which is such an awesome milestone for us to reach. So I wanted to take a moment and thank the people on the Stock Charts TV team that help us produce this show every day. They're not in front of the camera, but they do an incredible amount to make it look and sound and appear quite well. Sky Boggs is our lead producer. She's in my ear as we're doing the show. She's super funny. She's a great storyteller. She's a pleasure to work with. Tatiana Avery is our assistant producer. She does all the editing of the content. She wires me up. She writes cool signs that I get to show at the end of the show. Raquel Setterlund is controlling the show with the audio and visuals as the technical director, making sure that we look and sound fantastic. Abara Sander created all of the graphics that we use on the show. Rachel Ackley lines up all of our great guests that we get to talk with. Denvy Wright works behind the scenes to grow and manage our YouTube channel. And Chip Anderson said yes in September 2019 when I pitched him on the idea of doing a daily market recap show. And I'm so glad that he said yes. But most importantly, thank you guys all so much for watching. We'll hope to do 1,000 more and much beyond that. So happy Valentine's Day. Be well. Stay safe. Thanks so much for watching. And have a fantastic night. And thanks for helping us get to 1,000 episodes. Take care. Yay!